Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG. Thought we'd come to you today, give you a brief market update from our annual growth conference. So clearly I'm not in the podcast studio. I'm wearing a golf shirt and we are resort casual down here in Florida with a whole lot of our advisors focused on how we can better serve you as clients. So really excited about this week. In terms of what's going on in the markets, S&P 500 right at about 5,100. That is about 1% off its all-time high. So market doing very, very well overall this year. The thing that I will say about it is this is the second down day in a row. It's down a little bit today. Once again, only 1% off the all-time high. But if you log into CNBC right now, you'll see a headline about 2 down days in a row and the start of consolidation, and we'll just leave that there. But market doing fairly well, really driven by a couple of things coming out of last week. First and foremost, Jerome Powell testimony before Congress Thursday of last week indicated that he is still believing that we will have a couple of interest rate cuts this year, that the Fed isn't quite to the point where they are confident that the fight inflation against done, but they are very close to that level of confidence that will be necessary for them to start to cut interest rates. That's very important testimony because it's right around that inflection point of are rates stable to maybe declining versus stable to maybe increasing? And I think that that's a very important point for the market to keep in mind, or for you guys to keep in mind. So long as we're confident that rates for this cycle have peaked and that the next move is downward, I think both the bond market and the equity market will continue to say, okay, where the worst is sort of past us. If we were to flip over that inflection point and say, actually, we might have to move rates even higher to contain inflation, that would be something that the market would view as a bad sign. Powell coming out very clearly on Thursday and saying, nope, that's not the case. We feel like we're pretty confident that the fight against inflation is done. Not willing to call it yet, but pretty confident. So that's really the first point. Second point, got a jobs report out late last week, and those numbers were very, very positive for two reasons. First, economy added 275,000 jobs, which is a solid print. That is the third month in a row we've been over 200,000. So that's a great number in terms of overall economic growth, adding people to payrolls. The more people that are working, the better it is in terms of total economic output for the United States. But then even better, the Goldilocks scenario is that the unemployment rate actually went up. So we went from 3.7% last month to 3.9% this month. And that was driven by labor force participation, the number of people that want jobs in that core demographic, that core working demographic of 25 years old to 54 years old, jumped up to 83.5%. Which is the highest it's been since the early 2000s, which is really great to see. It is great to see because we're adding jobs, which means the economy can grow because there are more people working, but we've got even more people coming out of the woodwork, so to speak, that want those jobs and that are hard at work seeking them. That higher unemployment rate gives us a little bit of confidence that we won't see wage inflation that really pushes up prices, and prevents the Fed from being able to cut rates. So really sort of a Goldilocks jobs report last week. With that, all eyes this week will be focused on the CPI report out on Tuesday, looking for about a 0.3% print in the core. We will have to see how that comes out. With that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.